This is Tom Kozlik, the head of public policy and municipal strategy at Hilltop Securities. Thank you, everyone, for joining us today for this episode of our Hilltop Talks Politics and Finance podcast series for 2024. During this Hilltop Talks podcast discussions, we speak with subject matter experts about topics that intersect the worlds of politics and finance at the federal, state, and local levels in the U.S. We often concentrate on issues related to U.S. public finance and the U.S. municipal bond market. Today's episode is our fifth for 2024, and we have a very special guest that is going to inform us about what is happening in a specific area related to U.S. financial institutions and shed some light on what banks are doing on the investment side. And I know that that's something that many of our municipal bond market listeners are going to be interested in hearing about. I want to welcome Kris Johnson, who is the head of fixed income capital market strategies at Hilltop Securities. Kris, I'm very much looking forward to discussing the ever-changing landscape for depository institutions today. Thanks very much for joining us.
Thanks for having me, Tom.
So Kris and his team advise the management and boards of community financial institutions on holistic strategic planning, balance sheet strategy, and risk management. Kris, I'm going to jump right in here. These are topics that I know a lot of folks have been wondering about and thinking about, and especially the banking crisis or the liquidity crunch that impacted financial institutions in the spring of 23 stirred up memories of the '08 financial crisis for some or for many. How has the landscape for banking and financial institutions evolved or changed since the spring of last year?
Yeah, it's a topic that's on everybody's mind, and I think to get to where we were last spring, you kind of have to think about how we got there, right? And the community depositories, they got a whirlwind of cash from COVID relief via Fed quantitative easing, the PPP. The PPP gets its fair share of flack, but community bankers all over the country, they put in countless hours and effort to get the program operable and serve their customers and, sort of keep the economic picture afloat during that time. At the time, it felt like that money was going to come in and be lent out and kind of be a net zero. But obviously in the bigger picture, that was decision making that was very fraught, and the net result of how all the stimulus funds would be deployed through the financial system really weren't understood at that time. And a lot of that money was left or lent out, but it wasn't really spent. It just kind of sat there, and people didn't know when it was going to leave, when the loans would be forgiven, what that would look like, if there was going to be fraud associated with that. And sitting in a zero rate environment, with balance sheets that had essentially ballooned, all of a sudden 1% yielding bonds started to look relatively attractive, and people started putting their capital to work and cash to work, and that's how you got to basically 7 years worth of industry growth that happened over the span of a few short months, and outsized bond portfolios that nobody was really expecting the inflationary impacts of what was to come in the years ahead to really come to a head. Right. And so that led to obviously interest rate increases by the Fed. Fast forward 500 basis points, and you've got all of those 1% yielding bonds are now, extremely underwater, and it's sort of hamstrung the banks from a liquidity perspective. And so, I think it's 97% of the banks out there have, some form of loss, and they're available for sale securities portfolios. And if you have a lot of deposits leaving the bank like Silicon Valley did, and you have a bunch of underwater bonds, the only way to raise that liquidity is to take the loss, which impacts the capital. And that's what led to a lot of the bank failures.
So market uncertainty and especially monetary policy uncertainty has pretty much been a constant in recent years. I'd also add that market dynamics have been pretty crucial, as you've just been describing, and kind of shaping the performance of the financial sector over the last year. Of the kind of market and other factors, what have most affected the financial sector?
I mean, it's the interest rate environment.
Right.
Obviously what's happening with inflation, it's a little bit of a double-edged sword. It was very in vogue, for banks, especially, coming out of COVID. Everybody assumed rates were going to go up, to sort of position their assets shorter on the balance sheet. or assets on the balance sheet shorter on the yield curve. People were anticipating rates going higher. They had more variable rate exposures on the asset side. They sat in more cash because, as the bond math kind of tells us, as rates go up, the shorter we are in the curve, the better that we're going to perform. And those assets start repricing higher, yielding higher than, their liability base does in terms of funding costs. The problem is the industry being set up that way. They didn't really receive the benefit because all of a sudden, with things like Silicon Valley happening, those liabilities, they started to reprice a lot more quickly than, what their models were indicating and how they were sort of, looking at their risk from that perspective, because their low interest or non-interest bearing deposits were essentially leaving the bank or shifting out of the banking system altogether and going into short-term treasuries. They were going into higher interest-bearing deposits like CDs or money market accounts. And so all of a sudden you've got both the assets and the liabilities repricing in lockstep. And that's obviously led to, net interest margin compression. It's hurt earnings. It's caused a number of different headaches, across the banking sector, which has kind of led to the knife fight that we're seeing today, with respect to deposit gathering.
So on the cover of Section B of today's journal, there's an article titled "Banks Can Survive Worst Case Losses." Is that a good indicator for the financial sector?
I think it's an okay indicator. I don't know if it is viewed to be as useful as maybe it was when those stress tests came out after the great financial crisis. And basically, the largest banks in the country have to go through, some pretty significant stress tests in terms of, a severe downturn in the economic environment. Unemployment rates go into the double digits. You experience credit losses in your loan portfolios. It was really kind of a credit-centric reaction to what happened during the great financial crisis. And obviously, with what happened with the subprime mortgage market. So I think it can be an indicator if you're thinking of things, more broadly in the economy and what the impact of credit will be. But what it doesn't really take into account is what we experienced last spring, which is, the fallout of Silicon Valley. But, these tend to be reactionary and backward looking things. So again, we would expect, with the stress tests, and obviously there's some regulation coming afoot with respect to, liquidity management. A lot of that kind of falls in the asset liability modeling, banks making sure they've got, ample different sources of on and off balance sheet liquidity, stress testing their assumptions. Are there assumptions about how long those deposits are going to stick on their balance sheet reasonable? So you're going to see more shifts and more focus on that. But again, all of these things, they tend to be black swan in nature. So they're reactionary, but I'd say at the end of the day, it's an okay indicator.
Okay. So 2024 is half over now. Many expected the interest rate situation to be much different at this point compared to where we are as we're starting the second half of the year. You just noted or highlighted that the interest rate situation is definitely been important for the financial sector. Looking ahead to the rest of 2024, what are your expectations for financial sector performance in the last half of the year?
It's kind of the $64,000 question. If we rewind back to where we were at the end of the year, as depositories were putting together their budgets for 2024, a lot of people were actually looking at sector performance to be very favorable. And a lot of that was given that, there was 6 to 7 rate cuts that were baked in, between the beginning and the end of 2024. And why that's important for the financial sector is kind of what I discussed earlier in terms of the repricing of the deposits and the shift of deposit mix on bank balance sheets. Those interest-bearing or interest-linked type of deposits, those costs are going to go down because they tend to be pegged to the front end of the curve. So as the Fed lowers, the banks are basically going to get basis point for the most part. Reduction in cost of funds. Well, hopefully, they've still got assets that are generating, yields that are, well into the 6, 7, and 8% in their loan books. So a lot of people were looking at, the sector to have some margin expansion. We have not seen that. We continue to see, albeit muted, more of that transfer from non-interest bearing accounts into interest bearing liabilities, which is increased cost of funds. And then you have the credit impact too. So obviously, you've looked at what happened with New York Community Bank, the CRE specter that's hanging out there in the world. The market has been kind of tough in terms of, how they're viewing, the credit landscape. It's not as favorable as I think banks think it should be, just given the fact that, if I look at a piece of, commercial real estate in Manhattan, New York versus Manhattan, Kansas, those are two very different markets, two very different risk profiles. But, a lot of that has seemed to kind of get lobbed into one. So you've got, banks that are starting to reserve more. You are seeing delinquency rates climbing in certain loan portfolios and in certain markets. And there's really no clarity around, when the Fed's going to cut. I think we've got one cut sort of priced in around the election. There's obviously uncertainty around that. So performance is murky, at best. I think it would take some pretty considerable changes to the shape of the yield curve, to get something that looks more like a normal yield curve to really see any type of, meaningful outperformance in the sector right now.
So, and you started to kind of talk about this already, but expectations are still that it's possible the Fed begins to lower rates in the second half of the year. What type of investment or portfolio strategies are you talking to your depository clients about as a result?
Yeah, so there's a few things that are being brought to the table right now, and a lot of banks are completely on the sidelines with respect to their portfolios. They're taking the cash, the runoff from their investment portfolios. They're using it to pay off their funding. Their short-term funding, shrinking the balance sheet. Trying to right size, get back to more of what their core business looks like. Almost kind of like what the pre-COVID balance sheet was, so to speak, right? There's a lot of, artificially inflated balance sheets out there that I think are right sizing. And so there's a lot of folks that have just kind of said, hey, that'll be our strategy. They're also using their investment portfolio roll off to fund loan demand. I mean, there's still pockets of loan demand out there. So obviously a higher and better use for that cash instead of going into the fixed income portfolio and an inverted curve is, to go into, hopefully a floating rate commercial loan, or something of the like. But in terms of folks that are in the market, it really just depends on their balance sheet profile, right? And what their liquidity needs are, what their capital needs are. Obviously, you've seen some focus more on risk-based capital again. So making sure that that's being optimized as banks kind of think about, what do we want to look like 2-3 years from now, as well as, do we need to start locking in duration because, all signs are pointing to the Fed is going to have to lower rates at some point. It's just a question of when. We don't like to pretend we have the crystal ball and play the guessing game. So we try to look at exposures, right? And, if I'm looking and I'm seeing that a good chunk of the industry is more exposed to, lower earnings or hindered earnings in a down rate environment, we're trying to recommend to clients, it's not necessarily about the shape of the curve and the relative value out there. It's what type of value does it place on your balance sheet? You could argue the same thing for banks that still have rising rate types of exposures. We're saying be more on the front end of the curve. Again, banks that are maybe a little tighter on liquidity, you're looking at, cash flows in the mortgage sector, things that are kicking off a lot of cash, or shorter term ladders, or, even staying in things like T-bills, right? Just to keep sort of dry powder that's earning something and taking advantage of what you're getting on the front end. So it's really, situation and exposure specific, but those tend to be the general themes out there right now.
So it seems to me that some banks have minimized their buying of tax-exempt municipal bonds going back to either the Tax Cuts and Jobs Act of 2017, maybe even especially since interest rates started rising. Are municipals or have municipals or tax-exempt municipals been part of investment strategies that you've been talking to your clients about?
They are in the right situation. You know, it just depends. I think there's still a lot of pain out there from, the unrealized losses of bonds that were purchased sort of pre-rate hike or, pre 500 basis points of rate hikes.
Right.
So I think there's a little bit of heartburn there still.
Mhm.
There are certainly, types of institutions. If you're a sub S institution and you're paying a marginally higher tax rate than a C corp. Obviously, there's still some tax exempt benefits that exist out there. Folks that are kind of playing the longer game from that perspective, we still see. But in general, banks have not been large buyers of municipals, and certainly that's one of the major portions of overall portfolios that we see shrinking throughout the industry.
Right. In this environment, is hedging a critical strategy for managing risk for depository institutions?
Yes, absolutely. And I think it's one of those things where it's just another arrow in your quiver. And hedging for certain banks, obviously very large, sophisticated banks that have, kind of their own capital markets teams are actively engaged in strategies, whether it's on the balance sheet, whether it's looking at hedging their loan portfolios, individually. But again, those are just tools that are not really meant to create risk. They're meant to manage risk. And obviously those are places where we can make adjustments on the balance sheet, for exposures, whether we're looking at, hey, we're outside of policy in this rising rate scenario, or if the curve moves this direction, one way or another on the front end or the long end. It's a easier way to get in and change risk, without having to make drastic changes to your the items that are actually on your balance sheet, whether that's, your deposits, your loans, your securities portfolio. You're not having to move a lot of pieces around. You can place a hedge and essentially change the exposure there.
So, how is it that banks typically hedge their balance sheet risks, and what instruments are commonly used for that?
So when we talk about hedging, we're speaking specifically to interest rate risk, right? And so the most commonly used instrument is an interest rate swap, which is just exchanging cash flows, either fixed rate for floating or floating for fixed, right? And so, we can hedge, a different part of the curve where we have exposure, based on exposure rising rates or falling rates. So we can artificially create a fixed rate exposure to a floating rate or vice versa. The other thing that we see people use are caps and floors. And again, those are meant more to hedge the front end of the curve. So if I've got an exposure to, rising rates on the front end, like a deposit account or something like that, I can put a cap on that essentially says, okay, I'm not going to have to pay any more than this rate of interest on that. And if it goes above that strike rate, that dealer is going to pay me back. Or the same thing with the floor. If it goes below that rate, the dealer is going to pay me the difference below the strike rate there. So again, those are two different instruments, and really it just depends on what parts of the curve you're trying to hedge, what instruments you're trying to hedge. There's a whole bunch of different hedge accounting rules and suitability in terms of what types of instruments, but that's in a nutshell how banks are typically hedging.
Okay. So, how is it that depository institutions are managing their cost of funds right now?
The typical response that we're getting is banks are trying to run CD specials, right? And they're trying to go out and get money, in and hopefully they can bring in new money into the bank and not cannibalize their existing deposit base too much. And it's kind of a hope strategy.
Right.
Unfortunately, that's not the best out there. But we are seeing, institutions looking more, to the wholesale funding market. Like callable CDs, for example, you can issue a brokered CD, pay up for a call option. You have term rate protection if rates continue to rise. But if rates fall, the issuer of that CD owns a call option. They can essentially call that funding away and replace it with a cheaper source of funds. Same thing like I was talking about with the hedging with either swaps or caps or floors. You can put a cap against a short-term liability. You can put a swap against a liability, and use that to manage funding costs as well.
So I'm going to ask the final question here, Kris. I think this is kind of a little bit of from a bigger picture perspective. I'm wondering, what the future holds for community banking in general?
It's a great question, and I think at the end of the day, community banks are an essential part of the financial system in this country. I think there's a lot of people that have the view out there that we've got 4,000 plus banking institutions in this country. A lot of them very small, call it 250 million in assets and under, and those guys unfortunately are going to get rolled up, and we should have less banks. I disagree with that. I think there are, a lot of communities out there. There might only be one bank in town, right? And those are long time relationships. It's service, relationship oriented business that a lot of people still place a lot of value on. Believe it or not, there are people that still go to branches. Not of my generation probably, but there are certainly areas out there like that where the one bank in town is still a very important thing. It's the lifeblood of the community, and that I don't see that going away for a long time. You've had a lot of consolidation in the industry. I'd say leading up to COVID, on average, 200 banks merge or disappear each year. Which is roughly 5% of the overall bank world. So even to consolidate, if we were to double that, that goes from 200 to 400. It's going to take a long time, to see that. But again, changes in regulation, certainly are rendering a lot of community banks out there to have to make some tough decisions. Are we viable long term? Is there a succession plan? What does that look like if the bank is owned by a family? Does the family still want to own it? Are people looking for liquidity? Do they still want to own it or run it and operate it? There's a multitude of different things that people are having to weigh. Just from a viability standpoint. The regulatory costs are tremendous, especially for the banks at a smaller scale. And, a lot of people are effectively kind of getting priced out just from the regulation piece, which it's very unfortunate to see, but that's the sad reality. But again, I don't see it going away for a long time. And again, I think overall, there are so many communities out there that still place such a high value on, that relationship banking, and that won't go away for quite a while.
It seems like maybe changes in technology and how that's impacting the landscape. That could be the topic of our next conversation. But thanks very much for that perspective. I appreciate that. I really appreciate the fact that you joined us today. I really enjoyed our discussion.
Me as well, Tom. Thanks for having me.
And for those interested, you can also see the recent Hilltop Securities economic and municipal commentary and listen to our podcasts by going to HilltopSecurities.com/commentary. And you can follow me on X and LinkedIn. Thanks again, everyone. We look forward to bringing you more color in the future related to topics that intersect the world of politics, finance, and public finance. This has been Tom Kozlik from Hilltop Securities.